Hi, I'm Myssy, founder and director of Myssy Co, a professional services firm based in Sydney. Today's video is all about negative gearing. I'll be walking you through what is an example of how negative gearing works. Before I continue, however, please note that this video should not be seen as a reflection on our views of the current state of the property market and thoughts on whether to invest or not. We always recommend that you seek tailored professional guidance to ensure that it takes into account your personal circumstances, objectives, and needs. If your property is negatively geared, you can offset the loss against your assessable income. As a result, a lot of investors actually opt for a negative gearing strategy because of this tax offset. Okay, so what exactly is a negative gearing strategy? Well, it's simply the process of applying an investment loss against other types of income, such as your salary and wages. When this investment loss is offset against other taxable income, you essentially reduce your tax bill, which could mean a tax refund on the taxes your employer or business has paid on your behalf. There is a common misconception that negative gearing means making a loss, which means you're out of pocket on your investment. And because of that misconception, it's sometimes criticized as a strategy of losing money to then get back some of it via a tax refund. And sure, it's true that the necessary component of negative gearing is a loss, but importantly, this loss can also be generated by non-cash accounting expenses like depreciation. The best negative gearing strategy, therefore, is one where you're generating an accounting loss, but you still have a positive cash flow whilst the property grows in value. In other words, you're not paying to hold the asset. Let's look at an example. Melanie bought a property for $650,000 and put down a deposit of $104,000. The rest was funded by a loan from the bank. The interest on that loan was 3% each year, and the capital growth rate was the same. The property is in an area with a relatively good rental yield, so she could rent it out for $510 per week, which is an annual rental income of $26,520. The interest expense each year is $17,541, and the property expenses in her first year of owning it totaled $9,617. So in terms of her pre-tax income, she was running at a slight loss. If you took her depreciation into account, Melanie could claim a deduction on the depreciation of her fixtures and fittings, which added up to $8,271, and on the depreciation of the building, which added up to $8,125. By claiming depreciation and deductions for her rental expenses, Melanie received a tax refund of $6,620, which essentially meant she had a positive cash flow of $5,462. So, although her property was negatively geared, she still pocketed money at the end of the day. After 10 years of using a negatively geared strategy and claiming her tax deductions, Melanie's tax refunds totaled $50,320. I hope you have found this video helpful as a part of your journey to financial success. Thanks for watching.